Thank you very much for coming here tonight. Thanks to Metastack for inviting me. You know, I go back with Metastack so many years. It's scary. I think I got my first copy of Metastack in hold on to a chair. Let's say 1980 maybe. 79. Jeff probably wasn't even born then, several years ago, several decades ago. In any case, pleasure to be here. So what I would like us to do is this. We have an hour, and I would like to take, maybe about 20 minutes with a monologue, so to speak. We will begin by reviewing the U.S. stock market, and then I will take questions and answers. One topic which I think if you like, I can speak about is the current situation in Ukraine, in Crimea, and how that may affect the stock market. Sort of hot topic. Certainly the market got hit yesterday and it flew today. And since I grew up in that part of the world and actually been to Crimea many times, I certainly have my own view about what's happening. So we can discuss that. So let's talk about the overall markets first. For those of you who are new, as Jeff suggested, I wrote several books which you may want to read. Trading for a Living is probably my most famous book. There's also Come Into My Trading Room, which I think is the best book out so far. That's where you will see descriptions of indicators, all of them programmed into Metastack. And one of the key principles in all of those books is that we're going to use triple screen trading system, which means that we're going to begin with a long-term chart. We will make a strategic decision on the long-term chart, and then we will make a tactical decision on a short-term chart, on a daily. I see somebody saying should be a fan club for Elder. Come to spiketrade.com. That's the fan club. Spiketrade.com. That's where I live. That's where I post almost every day. So let's begin, Jeff, if you don't mind. Let's put up a chart, a weekly chart. It has to be of the let's say of the S&P 500, a weekly chart of the S&P 500, okay. What you see here is basically what I like to work with. I think that most traders grossly confuse themselves by using way too many indicators. I use something I call 5 bullets to a clip. An old army rifle took 5 bullets, and so I think an indicator can, a trader can use 5 indicators, and that should be perfectly sufficient to make decisions. Look, we're looking at only 5 pieces of data: open, high, low, close, and volume. And if you use 10, 15, 20 indicators, it's not going to help you. We have 5 incoming, so let's not overdo it with indicators. So when I use indicators, there are certain tools that I like to put on every chart, and you're seeing it actually, most of them on this chart. First of all, I want to throw a pair of moving averages on the chart, a long-term and a short-term moving average. You see a blue line and a red line. And if I were to ask you, and Jeff, you can see the blue line almost like has a shadow. There is a second line shadowing it, probably having one indicator too many. But that's we can, yeah, nuke it or leave it. We can live with that, but better without. So if I were to ask you which of these two lines, the blue lines and the red lines, is a fast moving average and which one is slow, you could answer that question without even looking at the parameters. Why? Because the fast moving average hugs prices so much more closely, and so the red line is the fast moving average, and the blue line is the slow moving average. Thank you, Jeff. Now it's clearer. So you can see on this chart that prices are rising from the lower left corner to the upper right corner on the weekly chart. And as an old song said, you don't have to be a weatherman to tell which way the wind is blowing. We have a rising trend of the market. What's much more important is we have a rising trend of two moving averages. Both the slow and the fast moving averages are rising. I believe that one of the key, well, I not just believe, but I live that concept. I trade that concept. That's what I do. That there is a difference between price and value. Prices are easy. You can see a tag on the right side of the chart. That's the price. But what is value? What is the value of S&P? What is the value of any trading vehicle, of any stock or any commodity? Well, I believe that value lives in the zone between the two moving averages. And you can see on this chart how value keeps slowly rising and prices occasionally, most of the time, outpace value. But every once in a while there is a panic. And during that panic, you can see on this chart, prices come back into the value zone. So you have to ask yourself as a trader, are you a value trader or are you a momentum trader? So if you're a momentum trader, go ahead and buy it now. But if you're a value trader, which is what I am, if you're a value trader, I see an uptrend like this and I say to myself, let me look for buying opportunities during those pullbacks into value zone. I don't want to overpay. I want to buy value. And you can see how every few months, like clockwork, there is a panic. Prices come down. Where? Into the value zone. So on the weekly chart of the S&P, the chart is clearly bullish. And that's a strategic decision. I cannot trade the weekly chart. I can make a strategic decision on it. Then I'm going to drop down to the daily chart and look for tactical decisions, what to do. Jeff, if you don't mind, let's switch to the daily chart of the S&P now. You see, I think this is a hugely important thing. We're going to make, you know, think about this way. If you're building a database, whatever it is, you decide to put the names of all your friends and acquaintances into a spreadsheet, you have to atomize the database. What it means is that you break it into as small pieces of information as possible. So for example, if I'm putting Jeff Gibby into database, I will have two fields. I will have a field Jeff for the first name, and I will have a field Gibby for the last name. Why don't I put them together into the same cell? Because it will make searching more difficult. In order to make the database more useful, I want to atomize it. Same way with trading decisions. I want to atomize my decisions, and so I want to make strategic decisions on a long-term chart, tactical decisions on a short-term chart, strategic on the weekly, tactical on the daily. So here you look at the daily chart, and what do we see? We had a buy signal yesterday. Yesterday, when the market dropped 16, S&P dropped 16 points on that Crimean business. That was the buy signal. It look at the, if you can, Jeff, actually, if you can blow it up a little, zoom in a bit into this chart. Thank you very much. You can see how prices opened flat, stabbed down, came straight into where? The value zone, rejected the value zone and closed above it. I mean, there was a screaming in your face buy signal, which actually I posted last night in spiketrade.com. Today, a fantastic rally. And where does this rally go? Well, it closed for the day above the upper channel line. And that's the second indicator, which I like putting on every single chart, a set of channels. And with Metastock, you're fortunate because we have this elder disk from Metastock, which has this absolutely unique tool called the auto envelope. Usually when you want to put an envelope on any trading vehicle, you have to play, do you want it to be 2% or 3% or 5%? You want to have an envelope which contains about 95% of the data, so that only extreme prices are outside and normal prices are inside. With Metastock, there's an elder disk, which I'm sure Jeff will talk to you about, which has auto envelope, which automatically sets a perfect envelope for any trading vehicle, whether you're looking at a 50-cent stock or at 2,000 point index. So what is this indicator, the auto envelope, telling us here? When prices, let me backtrack a little. Warren Buffett, not a technical analyst, of course, but a great market investor, is fond of saying that when you buy a stock, you become a partner of this crazy fellow whom he calls Mr. Market. And this Mr. Market is manic depressive. Most of the time you should ignore him because he is crazy, but occasionally he becomes so depressed he wants to sell you his share for a song, and that's when you should buy. At other times he becomes so manic that he offers you a fortune for your share, and that's when you should sell. Buffett, of course, decides what's manic and what's depressed based on fundamental analysis, but I use it on, I use the envelope for that purpose. So you can see how when our patient, Mr. S&P, becomes depressed and goes below the lower channel line, he actually creates a wonderful buying opportunity. And where did Mr. S&P end up today? Well, he is manic. I used to work in a psychiatric hospital. I saw my share of manic patients, and in the days before medications became widely available, we used to tie them to the bed to prevent them just from running around the room and banging into walls and perhaps even accidentally falling out the window. So Mr. S&P is manic today. And here you have, in the simplest way possible, let's buy value, let's buy depression, and let's sell mania. You know, there's an old joke. They say a neurotic builds castles in the clouds, a psychotic lives in those castles, and a psychiatrist is the fellow who collects the rent. Well, I want to collect rent from this crazy behavior, and so that's what I do. Buy below value. Well, buy value, buy depression, and sell mania. And so at the right edge of the screen, you can see how the trade, which began yesterday, by the end of the day today, has achieved its target. And this is what I do as a swing trader. Basically, you can see this channel on the screen. If you can catch 1/3 of that channel, you are an A trader. People make trading needlessly complicated. But what I'm showing to you today, using long-term time frame to make a strategic decision, using short-term time frame to make a tactical decision, this is really, you know, this is not upper-level math. This is something that you can do using essentially MetaStock software. There was a very famous mathematician, Benoit Mandelbrot. He died about a year ago, and some years ago the Egyptian government hired him to model cotton prices, because cotton is the major export, or was a major export of Egypt. So this great mathematician spent time modeling cotton prices, and in the end he came up with this. Hold on to a chair. Markets fluctuate above and below value. That's it. This is the math. Markets fluctuate above and below value. So if we can have a tool that shows us where value is, and that's the spread between the two moving averages, and if we have a tool that shows us where mania and depression are, we have a trading system right there in front of our face. I see somebody is asking which template am I using. I'm using LGDisc that MetaStock sells. Ask them for a discount, be sure. Not allowed to leave, that's right. I think I'm not allowed to leave, I should behave myself. So this is just using the broad market as a whole and looking at the analysis of this market. You know, I think that instead of me pontificating and delivering this monologue, I'm better off looking at your questions, and perhaps there are some stocks or you would like me to look at, or you know, any other questions, and let's deal with that. I see some. Carlos. Yes, Jeff.
I was going to say, do you want to look at gold?
You know, I very much.
What do you
I do.
Yeah. Go ahead.
Okay.
Okay. I'll change that over there.
Yeah. Let's take a look at weekly. Weekly. I don't want to see daily. Let's look weekly gold. You know, I didn't mention gold because I don't like to beat my own drum too much. But back in August, I began saying in all my classes that we're coming, and let's compress this chart, Jeff. Let's make it like a lot tighter. Let's show like 3-4 years history of gold. No, not zoom in, zoom out, zoom out. Yeah, keep on going, keep on going. Squeeze her hard, squeeze her hard. She's screaming, squeeze. That's it. Okay, no more, enough. In any case, maybe zoom in a little. It's too much, too tight now. In any case, back in August or September of 2013, I started saying to anybody who would listen, gold is coming into a major buy area, and when it came into that area, I was loading up on stocks, and I'm loaded up on gold stocks right now, and I continue to load up on gold stocks, and I want to explain to you, I want to show to you why. Gold spent several years hitting its head against resistance, $1,000 an ounce. It actually hit that zone 4 times. It broke through on the 5th time. And at that time, I was saying that once gold broke above $1,000 an ounce, we're not likely to see $1,000 an ounce in our lifetime. It reminded me of what happened to the Dow. The Dow used to die at 1,000 point level. The level between 950 and 1,050 on the Dow was called the graveyard in the sky, because every time the Dow came to that level for decades, it would collapse into a bear market. And then it broke above that level and never looked back, whereas the Dow is today. Same thing with gold, I believe. It broke through 1,000, and if you look at the left side of this, at the left half of this chart, you can see this very healthy rally, and it has a very clear pattern. Gold goes crazy, it goes manic, goes above the upper channel line, pull back to value, rests a little, goes crazy again, pull back to value. And finally, in the middle of the chart, when gold was hitting $1,900 an ounce, it went seriously crazy, and you can see how for how for a long period of time it basically boiled at that level. And people love buying high, so good luck. Gold began to pull back. I thought that it was going to bottom out at about 1,500, and I was actually buying it there. And then one day I didn't like how it was acting, and I sold it. And then next morning I opened my quote screen, and I see gold is down $100. I thought it was a bad tick. Well, it wasn't a bad tick. Gold broke through 1,500 and really began to collapse. Jeff, you want to Jeff, you've got to mute yourself, because when you don't, it really kills the audio. It sounds very noisy. Thank you very much. Jeff, I enjoy talking with you every time, but not in this environment. In any case, Jeff, if you could put a pointer, you see there is like on the way down in gold, there is like a red finger sticking out of the envelope, about an inch from the right edge. Yeah, a little bit to the left, a little bit to the left. No, that's it. You see this tremendous break. Gold breaks out of the lower channel line, pulls back in, and then it goes back down again. Jeff, hold that cursor a little lower. You can see the next low. After this one, the next major red low. And take a look down. Take a look at MACD histogram. Look at this major bottom of MACD histogram and the MACD lines. That's normal behavior. The market is collapsing and the MACD histogram is showing new lows. It stages a pullback to value. and look how gold pulls up into its value zone, and MACD histogram goes positive. And at that point, I began to say to anybody who would listen that we have point A, the first bottom, we have point B, breaking the back of the bear, I call it, because the MACD histogram crossed above zero. Let's wait for point C, when MACD histogram goes negative again. And Jeff, if you can please put a cursor, keep on going right, where MACD histogram went below zero. Put it to my MACD histogram, not to price. Yeah, you see where it went negative again. Look at this, a double bottom in gold, and compare the bottoms of MACD histogram. This is a screaming bullish divergence in your face. That's when I started going, and these kinds of divergences tend to support major moves. We're not looking at a couple of weeks rally in gold. I think we're looking at a multi-months and maybe more than a year rally in gold from here. So this to me is a major buy signal in gold, which materialized in December. And ever since then, let's switch to the daily chart, Jeff, if you don't mind. And ever since then, whenever gold has a little panic, it's a buying opportunity. Let's zoom in now. Let's see more. Zoom in more. Okay, that's it. Stop. You know, a little, one step back. Zoom out one step. You see? Near the left edge of the chart, that was December. And that was the last episode of depressive behavior. The patient was depressed. He actually made a little new low there in the center. And then he decided, no, he's not going to starve himself to death. He actually likes living. And he's going to stay alive. And you can see how the rally began. And at first it was a modest rally, a little bit above value and back, a little bit above value and back. And now it's getting a little swingier here. A lot above value, go and then a pull back to value. But let's take a look at some gold stocks. Jeff, how about just on the daily chart, not weekly? Pull up this stock, ANV, Allied Nevada Gold. And in the interest of full disclosure, I have it. I have a position in it, as well as in many others. Look at this. I mean, is this a thing of beauty or is this a thing of beauty? Look at it. Rally, goes manic, pulls back to value. Rally, goes manic, pull back to value. It's you know, I'm sorry Benoit Mandelbrot is dead. I would have sent him a box of chocolate just for conceptualizing this wonderful thing. Market, quote unquote, markets fluctuate above and below value. So that's the story. So that's gold. That's gold. And yes, MACD histogram turned lower. I see somebody making, of course it turned lower. What do you think? It's going to go up all the time? Jeff is going to have to put a second screen on top of the first one. I mean, indicators oscillate. You know, they cannot go up nonstop. Prices oscillate. And if you look, you know, you have to put all this information together, the weekly, strategic, the daily, tactical, and then go with the preponderance of evidence. You're always going to have something, well, what about? Well, what about? All right, so that's gold. Would I look at natural gas? Yeah, let's take a look at the weekly chart, Jeff, weekly chart. We're going, this is the habit I want you to develop. You begin with the weekly chart. Begin with the weekly, a little tighter, zoom out, please. You know, zoom out more. Show us like a several years history. Okay, that's a little more maybe. Zoom out a bit more. Okay. This is a fantastic, you see? Thank you very much, Jeff. That's enough. Fantastic chart, just a fantastic chart. You see how nat gas collapsed in 2008. It took several years bottoming out. There is a, let's start zooming in step by step. Zoom in one step, Jeff. And if you please, if you could, you see there is a bottom in 2008, I believe, when it came down from the peak at the bottom of the channel. Can you draw a horizontal line through that bottom, please? Yeah, that's it. A horizontal line across the slope. What I want, well, Jeff is drawing this line. What I want a tiny bit higher. That's it. Thanks. What I want to say is that one of the clearest, best, powerful, and very, very logical signals in technical analysis is a false breakout. False breakout. Markets fluctuate looking for where business is. And they go to where business is, where they go to where the most volume of trading is. So when markets break down below support, as this market did in 2012, I'm sorry, as the market, thank you very much, Jeff, exactly where Jeff is pointing out, as the market breaks below support, it shows that they're trying to explore lower prices. And the market doesn't, and there is no volume there. So the market that rejects low prices and pulls back, so it broke below the support line. Once it pulls back up above the support line, it leaves behind what I call a false downside breakout. And from this point on, up, up, and away. You can also compare the depths of a MACD histogram at previous bottoms and at this bottom. So this pattern came in very slow. You know, these major moves, like what I showed you in gold and what you asked me to, I missed natural gas, so unfortunately I'm not in it, except for paying heating bills this winter. But these patterns look very much alike. They take a long time to develop, and you kind of see them developing. They take months to come into a major bottom like that. But once you identify the major bottom like that, you have a year or two of trading in the direction of the new uptrend. So very bullish. And let me also say, before we go to the daily chart, I just want to say one more thing. There is a sieving instrument called an ETF. There is a sieving instrument of natural gas, UNG, which is an ETF of UNG. And if you have nothing better to do on some cold winter night, put side by side a chart of natural gas and a chart of UNG, and you will have the answer why I don't touch ETF with a 10-foot pole. They don't track. They don't track. What you see on this chart, which is truth, which is reality, which is what is traded on the NYMEX in New York, this is natural gas. You put UNG next to it, it's a caricature. It's a joke. It's disgusting. So no ETFs for this camper. In any case, let's zoom in a little bit more towards the right edge on this chart of natural gas. Jeff, let's a couple more steps, a bit more. Stop. Okay, so look, the bull trend is definitely on. It got a little hysterical in February, and this kind of collapse is typical of commodities. They take well, I don't want to give you a whole lecture about carrying charges, but there is a reason why commodities have to have those quick deflations. But basically deflation occurred last week. And now looking at this chart, at the right edge of the chart, natural gas is back in the value zone. Let's take a look at the daily chart. The daily chart. What you see here is actually extremely educational. I'm glancing for a minute at the questions people are asking. You know, so I see somebody says Wyckoff spring. Yes, it is Wyckoff called it a spring, false downside breakout. Very much the same concept. People are asking about my indicators. steal a book from a library. No, don't steal a book from a library. I just gave $5 to my local library today. Buy a book or borrow a book from a trend call, come into my trading room. And all these indicators are explained with graphics and with charts and with logic and how come and this and that. So we're looking at this chart now. We're looking at the daily chart of natural gas. And again, here I'm an outsider. I don't have a position in it. What I would like to say is this. First of all, that this false breakout is a very powerful concept. First of all, if you just look at the chart alone, look at this very tall blue bar that occurred 1, 2, 3, 4, 7 trading days ago. You see this bar which really collapsed. What did it do? It opened in the range, it made a new high, sniffed the air, I didn't like that high, and it collapsed. So false downside breakout augured in the decline. Very tall blue bar, medium height red bar, and then a real tiny short red bar at the bottom. So this is it. It shows to you that as the decline gathers speed, it attracts less and less and less interest. At the right edge of the screen, you can see that the color of the bar has changed from red to blue. You know, this chart is colored. You see, every bar is either green or blue or red. You know, we don't do it because you know, for aesthetic purposes. You know, in that case, we would have chosen something more, you know, aqua or purple. But in any case, those three colors, green, red, and blue, they reflect the system I invented and popularized, and it's becoming increasingly popular. I hear the people using this language all the time. It's the impulse system. The impulse system goes red. It means you're allowed to sell short. You are not allowed to buy. And at the right edge of the screen, at the very, as of yesterday, as yesterday's bar, you can see how the impulse system has gone from red to blue, removing the prohibition against buying. So there you have it. The weekly trend is up. There is a pullback into the value zone. The daily trend pulled down to the depressed level, and the prohibition against buying has been lifted yesterday. Do I need to say anything else? Somebody is asking, what about candlesticks? Everything I'm showing to you today with bar charts can be done with candlesticks. I don't use candlesticks for one reason and one reason only. Too old. I am too old. Not as old as candlesticks. They're 300 years old, a little older than me. No, but seriously, when I was learning to trade, there were no candlesticks. By the time they appeared on the scene, I already knew what I was doing, and so I just stayed with bar charts. I never switched to candlesticks. I mean, I studied them enough to know what they're saying, but I think I get just as much of bar charts and indicators as candlesticks. But if you like candlesticks, by all means enjoy. Use candlesticks here. We looked at gold, we looked at crude oil. You know, somebody's asking, is blue neutral? When I first invented this impulse system, I thought, man, I remember it came to me, I thought I invented an automatic trading system. You know, blue, buy green, sell red, and move to hire minimum wage clerk to trigger the signals, move to Tahiti, collect the checks. It didn't work. It didn't work. This thing of buying green and selling red, it doesn't work because it kills you during the transitional stages. And then I realized this is not a trading system; it's a censorship system. You know, in the markets, you can do any which stupid thing to hurt yourself. And most of us have done them, myself included, of course. Nobody controls your behavior. This system is your censor. The system controls your behavior. When the impulse system goes green, you are prohibited from shorting. When the impulse system goes red, you're prohibited from buying. And when green or red disappear, become blue, that's when you can act. So if I want to buy natural gas, I feel like I'm a dog on a leash, looking at these red bars, not allowed to touch. But wait, my leash has been released. The impulse system is blue. Now I can buy. So this is the censorship system. Well, I'm sorry, Jeff, we're losing a genius among us. He says, audience seems excessively basic. Goodbye. The genius J is on his way out. Man, it won't be the same without him. So, you know, it's amazing how some people trade to make money, and some people come into the markets basically to have a pissing match. Al is asking, do I use MACD lines? I do. I do to a degree. I mean, I use MACD histogram all the time. But MACD lines are also important. Like, for example, on this chart of natural gas, you can see how the latest peak of MACD histogram and MACD lines is higher than the previous peak. It shows that it shows that bulls were extremely strong at the final peak, and so it's probably not the final peak of this move. Expect higher prices ahead. MK is asking euro Swiss franc. You know, it's too far. I can look at euro dollar, but euro Swiss franc is just too far from where I live. I don't have what Germans call Fingerspitzgefühl, finger feeling for those faraway markets. Ray is asking a good question. What about quants? You know, so much volume today is automatic machine-based trading. Well, those people and I, you know, we live on different islands. We live in different time zones. Quants trade for extremely short price periods. I mean, to hold a position for half a second, it's too long for them. My time frame is a few days. That's my favorite time frame for swing trading. So you know, those guys are catching quarter ticks and half ticks, and you know, they're there. Probably increase volatility for me, remind me to be a little sharper, more on my toes. But we live on different planets, and what I do and what they do is just completely different. And so I just stick to my knitting. Are there any markets where the strategy will not work? Well, there are lots of markets that will not work. It will not work in very thin markets. You know, you go and try to trade a market with very low volume. You know, for example, I will not touch a stock. I will not touch a stock that trades less than 500,000 shares a day. Because at that point, a hedge fund barging in with a 50,000 share order can really goose it up or hit it on the head. So I like to try to trade big liquid stocks. That's one example where I wouldn't use a strategy. You know, let me just to shift gears a little bit. Let me say, you know, the stock market has gone crazy, of course, with this Crimea situation. I just want to say a couple of words about it, and let me preface it by saying, I am no fan of Mr. Putin. He is a very anti-democratic guy, and I don't like him. But the thing with Crimea, Crimea has never been Ukrainian. Crimea was a part of Byzantine Empire, and when Byzantine Empire was overrun by the Turks, they lorded over Crimea. It was a big center of slave trade. That's where they raided Russia and Ukraine out of Crimea, which is a peninsula with a very narrow neck, easily defended. They ran this nasty business for centuries, basically kidnapping people into slavery. The word slave, by the way, comes from the word Slav, right? And eventually Russian Tsars made war on them, got stronger, took over Crimea. It was always Russian territory. In 1956, Nikita Khrushchev, our great communist leader, really crazy character, was drunk. And he, quote unquote, gave Crimea to Ukraine. You know, but it didn't matter because both Ukraine and Russia were parts of the Soviet Union, but he gave it to Ukraine. But then Ukraine became independent and kept Crimea, even though Crimea, the population is Russian and they had no interest in being in Crimea. They tried to separate, but they could not. So now, of course, Ukraine is in turmoil, and Putin used this turmoil to go and get Crimea back. People were afraid that military, people may start shooting. There will be no shooting. For example, Ukrainian army is an empty hulk. They sold. They have light weapons. They sold their heavy weaponry to Pakistan and Iraq and all these other wonderful places. In the entire Crimean Peninsula, they don't have a single tank. I mean, the country was run by thieves for the last 20 years. And there are no weapons left, so there will be no fighting, and it sort of straightens out the historical joke of giving a piece of land to another country. And Europeans understand that. Americans are making a lot of fuss, but the English, the Dutch are saying there will be no sanctions. It's their internal matter. Stay out of it. And because the stock market realizes that, and so this whole one day seizure, that hiccup that happened, is over, back to normal. So, in any case, let me stay away from politics. Jeff, let's take a look at NEM. I forget, somebody wanted to look at this Newmont Mining silver stock. If you guys like what we're doing here today, really, the website you want to come to is spiketrade.com. I was going to take you there today and show it to you, but I think we better stay with the charts. But SpikeTrade, S-P-I-K-E-T-R-A-D-E, spiketrade.com, that's where I live. In any case, Newmont Mining, silver mining company. Look at this. There is a downtrend in silver mining, right? Weekly chart. Let's start zooming in, Jeff. Let's start zooming in. Stop. Okay. And look what happened here. It took this stock a little longer time to find the bottom than gold. Gold bottomed out first. Look what happened in January. Look at this tall red bar near the right edge. And then it's followed by a very short bar. So bears run out of steam. Bears are at a new low. We have a downside breakout. Jeff, can you please draw a horizontal line across the previous bottom? Not this one, but the previous red line. No. Much closer to the right. That's it. Yeah. Here. Thank you very much. Right? So what did we have in January? We have a downside breakout. Well, amateurs love following breakouts. Professionals fade breakouts, trade against them. So I saw this thing, false downside breakout. Look down, look at a MACD histogram, and compare the depth of a MACD histogram further left and the depth of a MACD histogram now. Prices at a new record low, and the histogram is essentially flat. Bears are out of steam, completely out of steam. The impulse system switches from red to blue. We're allowed to buy. At the right edge of the screen, the impulse system in Newmont Mining is green. Let's go to the daily chart. Daily chart, it's not as clean a chart as gold, but nevertheless, you can see, well, well, the daily chart is rising, but it's not terribly attractive. I think that I think some, you have so many. You know what? If I find myself squinting at a chart, I just flip the page and go to the next one. I only want to trade stocks that leap at me from the screen, grab me by the face, and say, trade me. I got this impression from gold that we reviewed earlier today. I got this impression from natural gas, which we reviewed earlier today. And this thing I'm squinting at. If I'm squinting, spit on the fingers, flip the page. Next. Okay, we have about 10 minutes left. Oh, Syria. Let's put up a weekly chart of Syria. I'm a little humble on Syria because I had it, I sold it. Made some money, but nothing to write weekly chart, nothing to write home about. I was teaching a class at the Traders Expo last month in February in New York, and this gentleman came up to me and asked for a consultation on Syria. He told me that he bought a boatload of Syria between 40 and 70 cents. He spent $250,000, and his position now is $3.5 million. What should I do, buy or hold? I said to him, he probably knew much more about Syria than I did. But he was going to call me for a consultation. He calls me about a week later. Let's compress this chart. And he says, Jeff, let's compress this weekly chart a little. And he says, you're right. I think I know what to do about Syria. Syria has stalled because apparently a gentleman named Malone made an offer for it at 370 or so, and so Syria is stuck there. But Syria has $1 billion in cash, and it's worth much more than what this guy is offering. And so this guy said to me, I'm going to hold because I believe prices are going to a new high. That's the best I can do for you about Syria. I'm quoting a guy who has done a lot better in Syria than me, several orders of magnitude higher. But the uptrend is on. The uptrend is on. Syria poked a finger to the upper channel line, wide red bar as it collapsed from the upper channel line, and then it made 2 attempts to go lower. And the second attempt is more shallow than the first. If you look at MACD histogram below, it's rising from a very oversold bottom. MACD lines are bottoming out, and my multimillionaire student says that according to his reckoning, and this is the guy, remember, who turned $250,000 into $3.5 million, money talks. He believes the stock is worth much more, and he says he is holding. So best wishes to you, Syria. A question of stop losses. Stops are tough. And certainly explaining stops in 5 minutes is not going to do it. But let me just give you a few key principles on stops. First of all, stops are a must. Stops are a must. If you trade without stops, stops are terrible because stops cause whipsaws. You put a stop, market hits your stop, and then it goes away. And we all I hate stops, but I trade with stops. Because if you trade without stops, you will avoid whipsaws, and you're going to live very happily for a while, and then you're going to take a bullet because a huge move is going to begin, and you will give it more time, and all your savings for having avoided whipsaws are going to be wiped out. You must have stops. So that's principle 1. You must have them. Principle 2. In terms of placing stops, you don't want to place them too close to the market. you've got to figure out what I call the average level of market noise. How many cents or how many dollars does this market move in a day on average? Well, you want to put your stop further than that away from the market. In other words, if a market moves, let's say 60 cents a day, and you put your stop 40 cents from the market, you're just asking to be hit, right? So you have to put your stop several times average daily range away from the market. That's the second principle. And the third principle, extremely important, is that the size of your position must be determined by the distance from your entry to your stop. So, for example, you decide to buy. Let's say you decide to buy a stock at $20 and put a stop at 19. Well, you're risking $1 at this point on each share. If you decide that your maximum risk for this trade is $200, you can trade 200 shares. If you decide your maximum risk that you're going to take for this trade $1,000, you can trade 1,000 shares. And if you say, well, you know, $1 is not enough, I'm going to make it $1.50. Well, it's not 1,000 shares anymore, it's 600 shares, because now you're risking so much more per share. Those are the three key principles I'd like you to keep in mind. I see Guillermo saying use ATR to determine the stop. It's a fantastic idea, Guillermo. It's a wonderful idea. Do use ATR. My partner in SpikeTrade.com, Kerry Lavorne, he lives by ATRs, both for setting stops and for setting profit targets. Take profits at +1, +2, +3 ATR. Somebody that's going to take profits. What is ATR? ATR is average true range. Average true range is part of the directional system. Thank you very much for showing this. Thank you. You know what? If you can give me control, Jeff, for a second, let me actually show them something from SpikeTrade with ATRs. I just reactivated it. If you can let me share my screen, I'll do that. Thank you. Share my screen. Share. So I hope you see me now. Look, for example, we have a thing in SpikeTrade. We have a competition there. And this guy who won last week's competition, Philip W., he was a fantastic guy. He shows his trade. How does he get in on ATRs? How does he get out on ATRs? Took 8% profit in just one swing trade. 8.03 gain. But let me show you what Kerry is doing with ATRs. I click on Trader Education and I click on his post from tonight, US new high, new low index. Last night I did it. I posted my charts. Tonight is Kerry's turn. Take a look at this. On the left is the weekly chart of the S&P. On the right is the daily chart of the S&P. And you can see how S&P is contained within an envelope which has 3 ATRs, 3 ATRs up and 3 ATRs down. So average true range is a measure of normal market movement. Are you going to get 1 time normal market movement, 2 time, or 3 time? And here is an absolutely fabulous chart. I mean, this is the chart of the S&P with a 2 ATR trailing stop. How do you like that? We had a buy signal in early February, and we're still long. And I just love SpikeTrade. Jeff, back to you. You can take control away. So yes, ATR is fantastic business. In any case, Jeff, I realize it's 7 o'clock. I guess I have to stop talking. invite everybody to visit SpikeTrade, and thank you very much again for having given me this public platform. I trade alone from literally from a mountaintop, and doing something like this, being able to hang out with a couple of hundred people is a very pleasant event. Thank you very much. Thank you for coming in.
Thanks for coming today, Dr. Elder. I did notice on the site there's a $29 2-week trial. I would recommend you take a look at it. That's not a lot of money. And it's like anything else. If it helps you make money, you should do it. I do want to talk a little bit about Dr. Elder's trading room. It's always good to have here. This is a fairly large add-on. What we did is when we put it together, we put trading for a living and all of the indicators and systems into it from trading of a living and come into my trading room. And the result is a very, very good product. It's something that was, I think, a runner-up or one of the winners of the Stocks and Commodities Rewards this week, this year. I could be wrong on that. I'd have to actually go back and look. But I would recommend that you own this, and it's very, very cheap. Certainly at $300, it's nothing. We will do a special price. It's $199. If you're interested, if you have questions about it, you're more than welcome to talk to our guys. $199. I would say this is definitely one that should be in your toolbox. Thank you, Dr. Elder. It's always great to have you in here. That's really all I've got to say for tonight.
Thank you very much, Jeff. Thanks a lot, and looking forward to seeing you in New York.
Thanks, guys. Thanks, everyone. Thanks for coming, too.